Good evening. Good evening. Happy Thursday, everybody. Good to see everybody. Hello, Leonard. Leonard, I sent you an email, a direct email this time. I pulled the address. I sent it directly. You should have gotten one directly from me. Good evening, Stephen. So good to see you again. I hope your traveling was good. I hope you're back home and settled in. On Discord, you got on there as well. Love it. Love it. Glad to hear it. Tired, I bet. I bet. All right. It's good to see everybody. So I'm having to call another audible or an audible here. I'm gonna pull from our combo from last week, or I mean on Tuesday, because I was looking through and I didn't have what I needed to go through the trade logs. Because I want to be able to go through both the results page and the log, and I had a PDF of one and I couldn't find the other. So I have that it's on the radar. It's going to happen. It's going to happen sooner than later. But someone said, let's just talk about building an entire trade. And I thought that's a good idea. Um, the SMS setup has apparently snagged for some reason. And so I'm going to look into that, but I'm hopeful that that's resolved by the end of the weekend and that we're good to go on Monday. I'm ready to go. But what I thought was, you know what? What if we took something that would be considered, and that's what we're going to do tonight. So I'm already jumping in. I guess I should say, welcome formally to the Market Watch Group Trading Foundation's final class today. Next week, it's March. So we're supposed to get like some huge winter storm here this week. In fact, it might, like, I'm ready for it's been like in the 50s and I'm ready for spring. And they're like, it may get 8 inches of snow. My son's up in Billings, Montana, and he has spring break and he was going to drive down. And now we're like, I don't know if it's going to be drivable. Anyway, sorry, I just had a quick little bitch and moan about that. But in March, we are switching gears to options. I'm very excited. I love options. Anyways. Okay. So what we're going to do today instead is build a trade as if. So I'm going to walk through it. I have a handful of signals from our watch list. I've got a financial, I've got a couple of industrials and one retail that I would say are all in viable setups where all we need now is a trigger. Right? Where we say if tomorrow the buyers, and we'll look at a few of the financials, or not the financials, the technology that triggered today, where you're like, oh, I would have loved to have triggered earlier in the day when I'm first convinced the buyers have done enough. And that's what we're looking for. Right? So we're going to talk about that. So we're going to do a build a trade. So we're going to look at the various components, the setup, the trigger, right? We're going to look at if I took this trade as a stock trade versus if I took this as an options trade, how would I do it differently? And we may even place the orders to automate it and say, hey, let's automate this thing and see how far we can take it. That's my thought. Let me know. That was what I thought we would do for the bonus. It's relevant. It's specific to the current market. And I think it will help us better understand what you could do with the alerts potentially, whether you want to sit and watch it and manually enter them, or do you want to try to some extent automate the system. Ask questions, make comments as we go. Of course, as always, keep it a dialogue. I don't really love feeling like I'm monologuing. Monologuing's for villains. I'm not a villain. Build a trade. Here's the disclaimers as always, especially on a night when we talk about a potential trade. Remember that what we are doing is educational, illustrative only. It's not a recommendation to buy or sell anything. Of course, we are not advisors. We are not brokers. Any trade you take is your trade, yada, yada, yada. The agenda, we're going to talk about setups first. And then we're going to pick one as a group. We're going to say, hey, what do we like the best of these? Which one do we really want to flesh out, build it? put some trades in place and automate it and see. I'm going to do it on the paper account. When we get in, where would we put our initial stop if the trade triggers? Where would our stop loss be in that scenario? What's our targets? Where would we take some profits? Target number one versus primary target. Target number one is like, hey, where do I see a level where I might just be like, if I got 5 contracts, I'm going to sell 1 or 2. Or if I have 4 contracts, I'm going to sell 1 of them. Right. If we're more bullish, we're not going to sell as much. Just a little ease, some pressure on the trade. You lock in some gain, raise your stop. Okay, right? That's target number 1. That's optional. You might be like, nah, I'm riding it all to the primary target, which is where you really are looking for it to get to. We'll talk about trade management. When are we gonna tighten our stops? If I'm gonna tighten it, do I tighten it based on Heiken Ashi? Do I do daily? When do I go to 4 hour? Is there a time where I might even switch my chart to an hourly chart in how I manage the trade? And what are our final exits? What are some of the things where we're just saying, if it does this, I'm out. If it gets there, I'm out. If it's right, just really talk it through. Make sure you feel comfortable with that trade, every step of it. Bam. That's what we're doing today. Let's dive in. Oh, I'm not there yet. Let me keep it here. Oh, let's go through. Let's go through the setups as I see them. If you had been looking through our watch list and you said, I think there's something here, and we identified the same one, make sure you say, yeah, I saw that. Scott, I was thinking about that. If you have one that you think I'm missing, let me know. I'm open. I am open for it. Okay. First, Citi. Okay. This is candidate number 1. Candidate number 1. I'm just going to have you vote 1, 2, 3, 4, 5. So as we're going through these, we're just talking about setups and what would have us thinking there may be a trade in front of us. Yeah. So as we go through, just make a mental note which ones you like, and then we'll weigh in. What do I see here? Where's my drawing tools? That's one thing I need. Annotate. Okay. I traded this last one, right? I traded this last one here. And it moved. And then finally here, I'm like, okay. So I sold some of it on a Friday here. And then the rest of it, I got out here. I didn't sell this one. I held, and then I'm like, all right, I'm gone. So, but it was all profitable, made more here, obviously, than here. Now what? Well, it moved. It moved, right? It moved up, got to this level. It's the old high. And now it's pulling back. And I'm thinking to myself, okay, well, the sellers, you can see today we had above average volume. And you're like, it was a red candle. Nope, it was positive by almost 1%. But what do I see? I see we're in this kind of a flag type situation. You can see your stochastics is starting to turn, and you might think, I have a trade here. If what? If it starts to go up again. That's it. So we'd have to decide, where is that? Where is if it starts to go up again? So it might be at yesterday's high. It might be at the previous day's high, where you say, if it opens and breaks through this, I'm in. And this might be your level, 56.17, 56.20. What was the high here? 56.18, 56.20. So 56.20. Okay, that's what we're thinking about here, right? I'm not saying it's tradable now. I'm saying it's setting up that if it were to break to the upside, we're thinking time to get in. Candidate number 1, Citi. Candidate number 2, railroad, CSX. Now, keep in mind, there is a weird bad data feed. It did not ever do any of this. This didn't happen. But it did do the rest of this. So what did it do? Well, it popped up and it made a new high. The trend is good. It's in railroads. It's industrials. Now what? It's pulling back. Your stochastics is down, but pinching. And we're thinking what? We may have an opportunity here. So where would our entries be? I would say across today and yesterday's high versus the day before's high. And this is that entry zone. That's what you're going to see when I give an entry zone off of an alert. What are we thinking here? We're thinking when it crosses up, we think that this is done in its flag and it's breaking out. It's turning to the upside. So what would we maybe do? We would say my entry is at 38.15, 38.20. I mean, whatever you think is reasonable inside of here. You have a stop loss. Maybe it goes below the initial one here. So the low is 37.66. So maybe you go, 0.5% is 18 cents. 37.48. So in at 38.15, 37.48, taking about 65 cents of risk. So you're hoping to get a couple bucks if possible. Do we think this thing could get to $40.15? Maybe. You can see it made a nice move here. Pretty good move here. Maybe. So you might say to yourself, I could get 2.5 to 1 right up in this area, maybe. And that's your trade. Press, I appreciate you saying something. I was actually digging through and I'm like, I swear he had sent it to me before, but I couldn't find yours. And Steven had only sent me his results. He actually said something about it to me tonight as well. No big deal. We'll get to it. I'm glad you sent it. We will do it. But with that, I just said, you know what? Let's talk about setups. So anyways, that's what we're doing is really talking about automation of setups. So there you go. Just to give you a sense, since I had said we're going to look at yours. Okay, so I have a zone where I think the entry is. I have a potential stop loss where I say I'm going to put my stop underneath here and my target is going to be up here. And maybe I have a halfway point. That's target number one. That's primary. That's stop. So what we're doing is we're really exploring the exact parameters that this trade is how we're going to look to manage this trade. So we can quantify this and start to automate it. I can put a trade in where I say, all right, I'm going to buy when it crosses that first entry line in here. I'm going to buy 3 contracts of what? Well, we can go look at that in a second. That's exactly what we'll do. Not necessarily on this one, although I like the way this one looks. I mean, it's a very strong stock. It's got a great trend. It's pretty steady. Options are cheap. Look at that low vol. We could buy an option on that. Real cheap options on that. So this is candidate number 2. I'm going to let you guys vote. But this is what we're going to look to do is build this out and see how would we automate this trade. Okay. Number 3. Has anyone seen one that they're like, oh, I like the way that looked? PCAR. Nope. Let's type it. PCAR. This one's tough. I mean, this is a real strong flag pattern. A lot of people struggle trading patterns like these where it's just, but you can see back here what happened. Bam. It broke out of that little flag. You can see right here what happened. Broke out of that flag. So back here had a little bit more of a consolidation. Okay. I would say this one's probably the least. I would probably give this a little bit more time. That's a real tight flag. You can see today It did close near the low and there was some volume, so we'd want that to play out. So I don't know. Maybe I'll pull that one off the list. Let's just say we have number one, number two. We're going to skip this one, but you got to tell me, I mean, that looks strong, right? Like we should be looking for something out of this soon. And industrials has been a very, very strong sector. It doesn't show signs of really slowing down. Number three then is going to be out of the consumer discretionary. Nope, not Meta. That's not what I typed. TPR. TPR. So TPR has pulled back a little bit more. It had above average volume, but you can see it recovered a little bit. The stochastics hasn't come down by much, but very strong, very strong. Here's what we're kind of looking at. So what would I be thinking to myself? And this is what's tough, is I'd probably think maybe somewhere between, you could maybe even go a little further back. Like, where in here do you get convinced that it's breaking out, right? That it's busting out of this consolidation pattern? You know, you can see back here, it had a consolidation pattern, busted out, and then it was gone. Now that did have earnings, so that's tough. A little bit of a consolidation pattern here, busted out, gone. Bam. Right? So it's moving. This isn't for everyone. Right? This isn't for everyone, this thing. But what would we be thinking here? Well, if I can get in. Now, I don't know if I'd go back down here with my stop or if I'd be thinking, you know what, I'm going to go underneath these bodies and get it a little tighter, because by the time it breaks out, who knows, we want to keep our risk level in here pretty low if possible, so that we can see if this thing makes its move up. That's not bad. That's candidate number three. And then lastly, and then we're going to go forward with the next steps. Oh, okay. Here we go. Yeah, I remember that was another railroad, UNP. So UNP, CSX, they're kind of, very similar. These guys, did they just pay a dividend? It looks like it just went ex-dividend. All right, we have Citigroup out of the financials. We have CSX, a railroad, out of the industrials, or we have TPR out of the financials. I believe it's some kind of, or not financials, TPR out of consumer discretionary. Tapestry, some kind of a consumer site, I believe. And lastly, we have UNP, another railroad. Let's review the candidates one more time. Candidate number one. If you want to vote for candidate number one, put it in. This is Citi. This is Citi. What are the downsides? Well, it did have a same high. It didn't bust this time. We wanted a little more. It didn't give it, but still consolidating, still well above the 50. Candidate number one, Citigroup. Candidate number two. If you want to vote for candidate number two, we have CSX, a strong railroad out of the Southwest. I don't know, making that up. Just hit new highs, well above its 50 in a flag consolidation pattern. Candidate number two, for your viewing pleasure. Candidate number three, TPR, Tapestry. Not quite sure what Tapestry does. It's a strong accelerating trend. New highs, pulling back. Tapestry. And lastly, another railroad, another industrial, a direct competitor of CSX. Union Pacific. Fred says C, Citigroup. Paul says CSX. Okay. All right. Let's get those votes in there. What do you feel like trading? Right. So far, we have two. Let's go to those candidates. Citigroup. What do we know about them? The volatility also fairly low. Options trade should be pretty reasonable. Perry's leaning towards a C. That's two for Citigroup. Two for Citigroup, one for CSX Railroads. Come on, what do you want to see? These could be tradable tomorrow. Anybody else participating in the process? Okay. Citigroup it is. Hold on a second. First choice is CSX. Second choice is Tapestry, Steven said. Okay, now all of a sudden, we have a tie. We have a tie between Citi and CSX. So I'm either going to let the next vote for either Citi or CSX be the decider, or tie is going to go to the liquidity. The liquidity is going to be, we're going to look at the March options, the standard Marches, which is the 15s, the March 15s. I think it's the March 15s, right? Citi. March 15s. We're going to look at the money options, and we're going to see who has the most open interest. And I think that's going to put Citi well ahead, but let's just make sure I'm right. Citi is overbought. Oh, I'm okay with overbought. In a bullish market. We're going to see a lot of overbought in a bullish market. I'm okay with that. Open interest 65,000. CSX at the money. The 30. Oh gosh, yeah, these are not very many. It's not terrible. I'd still trade it. 259, 921, 286. It's not going to be great. It's not going to be great outside of the monthlies. You can see you only got about 150. And the spreads get a little iffier, but if you're sticking to the March, you can see 15-cent spread. It's a little more than 10%. 10-cent spread, a little more than 10% of the cost of the option. I'd rather not have that. So I don't love the options on CSX, but they are manageable options. You can see UNP is a little better, although you're still barely at that 10% mark. So these are a little tighter during the day. So I would say, you know what? I'm okay with it. Not ideal. Let's go with Citigroup. Citi's our horse today. Citi's our horse. If you don't like it, you can follow along. If I can't, I don't know why I can't just get symbols typed in. If you don't like it, follow along. What's the delta? If you're going to be at the money, you're probably looking at a delta of 0.5, maybe 0.55. We can take a quick look. See. 0.57. Okay, I was close. 0.55, 0.57. To be honest, I'd probably be looking for a 0.3 to 0.4 delta. I'm going to look to go a little bit out of the money. Maybe even 2 strikes out of the money, depending on how high I think it might go. So I'd rather, if I'm buying cheap options, go a little bit out, right? So if I go to the 56s, those are 88 cents. The delta's still 0.43. Yeah. Okay. So, but let's go take a look. Let's go put some numbers into play. So here's what we're going to do. We're going to analyze this thing now. I already have 4 of these on. Making money on the, okay. So let's, I sold my live ones. Apparently I still have these on. Even now they're still making some money, but we're not going to look at those. So don't worry about that. Let's start fresh. And let's get some numbers in here. So what's the first thing we're looking for? Well, we're looking for entries. So I would say the entry range, 38.10. We'll go 5 cents above, 38.15 to 38.28. Yeah. 38.28 is up here. So let's say just above this. No. 38. What did we say before? I think we said 38.15. 38.15 will be our entry point. So it's about 20 cents higher than now. We're looking to see this thing busting higher. BAC, you like oh, I'm on CSX. Sorry. I meant to go back to City. City is here. Bank of America. See, Bank of America is really already kind of in its move. If you look at the Heikin-Ashi candles here, you're on 1, 2, 3, 4, 5. You're 5 white candles in, right? I feel like we're behind that move. What are we looking for? We want to get in on the first white candle. How can you possibly know, Scott? I can't. I can't know, but I'll tell you what. When if you look back here, when this candle turned to this candle, right at the beginning of this line, guess what we're going to find? That if we had an entry trigger, it would have got us in right at the beginning. And that was right at the beginning of the move, right? Now, if I go back and I want to get in on the first white Heikin-Ashi, I want that. Well, we have to go back to these two here and figure out how would we possibly get in there. Well, if I put my entry above, then I'm going to get in right on that first one. It's going to trigger. I'm going to have a zone, and in that zone, so if I do the same thing here, I'm basically saying if it gets to, let's say we said this high, right? 56, what's the high here? 56.18, 56.20. If it gets to 56.20, right? If it gets to 56.20, that's enough. And we're getting in. So if it just drops tomorrow, we're not getting in. It's got to get up here to 56.20. It's got to trigger it. And if it triggers it, guess what's going to happen? This is going to turn into a white candle. How do I know that? Because the next Heikin-Ashi is going to open right here at the midpoint of this body, right there. And if it gets up to 56.20, it's going to force it into this candle here. It's going to look like that. And if it never goes below that at any point, then it's going to look like this if it gets up to 56.20. That's the first white candle. How could we possibly get that? That's how. Do you see? Right? So that's how. And so Steven said, my bet is it will not make it past 55.75. Great. Then the trade doesn't trigger. Beautiful. Win-win. If it does, that's what we're saying here, yeah? Is when are we convinced that the buyers are coming back in? And how can we use that to find our way to get in there? And to find our way to get in there, right? And do it over and over again. How can I possibly do that? Well, the first thing we have to do to catch the beginning of these white ones is to recognize what's happening before the white, right? Before the white, it's this and this and this. You had a little one right here, a little bit of sideways there. Those are your consolidations. It's consolidating. We want to trade into this when it's what? Done consolidating. And that's all we're looking for here. If it's not done, we don't get in. So our entry being up there at 56.20, if it's done consolidating and it's breaking out, we want in. Where would this have worked? Where would this have worked? You might be asking yourselves. I'm asking myself that. On Amazon. First white candle, right? Now, if you look back at the standard candle, look at this day. If you get in now, You're well behind it. When would we have wanted to have gotten in? Somewhere between the high of this day, which was 174.05, and the high of this day, 174.62. So somewhere around 174, let's say 40 or so, which is like right in here somewhere. If you had gotten in there, you're already well up on this trade, right? Otherwise, you're behind it. And now you're like, well, do I chase it? So that's what you're thinking about. Is there going to be a time where you get in and it falls back? Of course, that will happen. But this thought process, how could we have known this? We couldn't know it. All we could do is say, you know what? If it opens now, this one, the tough one is this. Let's go back to City for 1 second, and then we're going to take this to the next step. We have to decide where is it no longer valid. So if I like it at 56, I might even say I like it prior to this high. I might go this high here. What's the high of this? High is 50. I'd say, yeah, maybe even 56. What was this one? 56.18. Maybe like 56.05. Anyways, where is it no longer valid? Right? If it goes to 56.60, it's too much, because by the time we get in up here and our stops down here, it doesn't have as much to go, right? It doesn't have as much to go. So we're thinking about putting that type of a zone in. Okay, so let's just go build a quick sense of this trade. If I were to, now, how long do we think we need this for? Citigroup, we could go, this thing has weeklies. So if we wanted to get like, a month, we could go out to the March 28th. Why is it March 28th? Is that Easter? March 29th? Is that Easter? Is that Good Friday? That's probably what it is, right? All right, so we could go out here March 28th. Now, what are the targets where we think this thing is going? Let's say we said a couple of points, right? If I were to move this again and say that's what I'm looking for on the breakout, I would say target number one maybe is right here at 58. Target number two, 60.25. Okay, let's see. 60.25 and 58. And let's reorder these. How do I reorder these? Okay, and the last one, our stop loss, we're gonna put that down. So let's see, 56. So two in. I'd like to only be like a 56 to 55. Okay, what's the low here? 55. I'd probably go like 54.75 for a stop. 54.75 for the stop. But we're at 55.40. Give me just 1 second here. 55.40, 55.75. So if we do 55.45, is that what I said? I have to translate this a little bit. 54.75. About $1.40. About $1.40. So let's put this at 54. Okay. What strike price do we think I think we could get these 57s. And you can see I'm risking about 50 bucks a contract. Now let's get this out a little bit in time. We're going to take this out to the 6th. Boom, boom, boom. About 55 a contract. So you can see we're about 2-1. We're about 2-1 to our target number 1 with this. And a little bit better than that. We're about that's like 5-1 if we can get that bigger move. Now, that would be 10 contracts. Let's reduce this down to 5 contracts. And what I'm going to do is I'm going to just go ahead and create a duplicate order. Now I'm in the order entry, right? And now I can do a first trigger 2 OCOs. So I'm going to buy, and then I'm going to opposite, duplicate, duplicate, duplicate. Okay, now what? So I'm buying 5 of these, and I'm going to sell. The first OCO is going to be for 2 contracts, okay? 2 contracts. And I'm going to make these. Actually, I'm not going to do OCO. I am going to do OCOs. I am going to do OCOs. We reckon we're going to lose. Reckon. I reckon. Let's go back here. What do we say? This would be about 277 out of, so it'd be about 55%. So let's put our stop at 45 cents. That's about 50 cents. If we said 55, so we'll put our stop at 40. Stop at 40. Let's go back in here to the trade tab. So we're going to do a stop of 40 cents. And we're going to make that good till canceled. Now, the limit, we were looking for 2-1. So we're going to double up on that one. If we're going to lose 55, we're looking to make 110. So $1, we're going to say 204 to the upside. $2.04. Nope, that's the stop. Sorry. That's still 40. First limit is going to be 204. Now we're going to do another stop and another limit for the other 3 contracts. So we're splitting this thing up. 3 here and 3 here. Everything's going to be good till canceled. And we're going to make the stop 40 cents. When we're wrong, we're wrong. So we have 5 contracts, all of them at a stop of 40. So what are you risking here? You're risking 55 cents, $55 times 5 contracts, which is approximately $275. That's the total risk. You could dial that down. You could do 3 contracts total, and you could sell 1, and then you could sell the other 2. And that will go. Yep. Good till canceled. Thank you, Stephen. So that, however you decide to split this up, it's $55 of risk approximately per contract. Now, of course, we never know if we're going to get guaranteed that or not, so it could be worse. But we're looking to get 2-1 on the first one. The second one, we thought 5-1. But you know what? I'm going to just say I'm looking for 4-1, which is now 4-1 is on risk. Risk is 55. So that's $2.20 on top of what I paid for it. So $2.20 on top of 94, $3.14. So I'm going to put $3.14 over here. That's a 2-1 and a 4-1. 2-1 on the first two, 4-1 on the second three. Everything stops out. Now, this is only a day order. And the last thing I have to do here is I have to give this a limit, right? This is not, I'm going to get in at 94 cents. This is, I'm going to, and we'll have to maybe come back in and make some adjustments, but we're going to come in and we're going to say, good for the day. If Citigroup goes at or above 56.05, 56.05, we said. But if we go, no, I can't put above because it's already above. Yeah, it's got to be above here, but it's got to be below. What do we say? 56.55? No, 56.50. What do we say? 56.50 for now. I'll come back to this. Hold on. So you can see that's this little, see this little cog right here? This is where the conditions can go. And I can put conditions on buys. So I'm basically saying I want to buy these options at what price? I don't know. As soon as it crosses 56.05, as long as it didn't get above 56.50, right? That's the condition. If it's in that range, it's going to buy it at market. And then as soon as it buys it at market, it's going to put these stops in. And I'll probably have to go back in and adjust them because if it buys it at a higher price, I need to move my stop so that it's 55 cents below, but the rest of it, you can make that adjustment. We don't expect this thing to fill. It's just getting you in with your initial assumptions in place, right? With your risk managed, your stops, your targets, and then you can fine tune it once the trade is on. You can make those adjustments at night at any point. Was 56.50 what we said? I can't remember now. 56, maybe below, not above 56.45. How about that? 56.45, no go. It's got to be in that range. Breakout, but not by too much. I mean, that's almost a 1% range. So we'll save that, confirm and send. Here's what this looks like. Okay. I'm buying these at market. If Citi goes above 56.05, but doesn't go too far above 56.45. If it triggers, I want to immediately put in my stop and my targets that are giving me 2-1 and 4-1. I'm risking 55 to make $1.10, risking 55 to make 220. Now, if I get in, this is based off around 95 cents. If I get in at $1.15, I can go in and I can just kind of correlate everything up a little bit and just say, you know what? I'm going to move my stop to 60 cents, my target to 244. And then, you know, we can just kind of make those adjustments. We don't really expect that to hit early on, but it's just giving you practice to automate as much as possible. If you forget to go back in, the orders are there, but the best thing is to go in there and make those. So I'm going to go ahead and place this trade. Boom. Now, there's funky things sometimes. If it rejects the order, you did something wrong, but we didn't. Everything's in place. It's now a working order. So this is what it looks like. If you're looking to automate anything that comes your way by alerts, if you have a hard time trading during the day and seeing things, this is a great way to go, right? You automate it and then you can make adjustments to it. What is my trade management going to be? You know, I'm going to use the Heikin Ashi. I'm going to use the Heikin Ashi until it crosses 58. When it crosses 58, I've already sold half at a 2-1, not half. I sold 40% at a 2-1 ratio. So I got a 2R multiple on 40% of the trade. And now I'm going to start tightening my stop up more aggressively on the rest of it, trying to ride it to the 4-1. But if it gets to 3.5 to 1 and rolls over, I don't want to give it all back. So I'm going to probably move when it crosses 58.5, 59. I'm going to move to a 4-hour Heikin Ashi chart, which means I have to make the adjustment twice a day, not once a day. And I'm going to go in and I'm going to have a trail stop on those other ones. I'm going to cancel that initial stop. I'm not going to have, right? I'm going to go in and I'm going to use a trail stop, and I'm just going to use whatever the Heikin Ashi low is. and I don't have to actually do anything. When I get to that point, I can just sort of, I can change my stop to a conditional where I'm actually setting it directly proportional to the stock price. So let's keep our eye on this city trade together. I'll point this out to people that they can go watch the recording so they could see this is trying to automate as much as you can automate. And you're just, if it gets to your target, bam, gone. Right? That's it. It's out. It made its money. It's going to book your profit. And here's what you have. The first two contracts are risking approximately $55, so 110. For what? 220. If the first trade hits, it's going to book approximately a $220 gain. It's going to leave you with 3 more contracts, which at the time will have about $330 in gain, but you think there's more available. But you're going to start moving your stop so that even if it falls apart, you still keep 100, 150 of it. And then if it gets to 500, you're going to keep at least 350 of it. And then, right, and as it's moving higher, that last piece, you're tightening your stop. And when it finally gets to your target and it's automatic, great, you're out. What do some people do? They watch it and they're like, oh, it may went a little higher. It could have gotten. Then great. If you notice a pattern that on 3, 4, 5 trades in a row, it sold and then went higher, then start setting your target high. Don't change the system, change the parameters of the system. The system's working. And if you find that you're not getting to your target, if every single time you sell some and then try to ride some, and then eventually it just stops you out and stops you out and stops you out, if you're never getting to that primary target, it's telling you something. You're setting your primary target too high, right? But this is, all we're doing is we're looking at this. We're looking at what has it done? What does the trend tell us? What is it informing us? If this thing, Stephen thinks this thing probably won't break out, it's going to fall back. Great. Then guess what? Then this looks like it was going to pinch. Sometimes it looks like that and then falls some more. And then maybe there's a trade here at 53.5, right on top of the 50-day. Fine. Then we readjust. If this doesn't fill tomorrow, all of these good till cancel orders are predicated on the first order filling. Waiting for trigger, waiting for trigger, waiting for trigger, waiting for trigger. This guy is waiting for a condition. These are trigger orders. This is a conditional order. If this condition is never met by the end of tomorrow, this day order cancels at 4 p.m. Eastern. And with it, all of these subsequent orders. The whole kit and caboodle cancels. Now, if I thought the trade was still valid, I could go back and I could just reconstruct the whole thing. Right? I could just be like, hey, let's try this again. And I might reconfigure the numbers. And I'll say, but this time I want in if it breaks above this number and this, right? And great, because right now we're thinking great. We're thinking, well, we don't know if tomorrow morning the market just takes off, we got good inflationary data, the market liked it. If tomorrow morning the market takes off and this thing triggers, and then all of a sudden you come in and it's already up a little bit, you're like, okay, great. Okay. So questions, comments, concerns. Otherwise, I'll tell you what, this is what you're going to get. On this, if this city trade came out as an alert, I would say that the entry zone was between, 50, 55, 75 and 56.20. And so that's anywhere in that range. You could decide, I don't like it until it gets to the top of the range. Great. In your trade setup, you are not expecting it to go past 57 to get the order placed and to get your 4-to-1. No. I'm not expecting it to go past 56.40 tomorrow only. Only tomorrow. What that's preventing, Stephen, is if tomorrow this thing gapped up to 57 I don't want to enter here. If I enter at 57, there's no way I'm getting 2-1 at 58, right? The only way I can get 2-1 is if I'm entering down here, and we've said by 56.40. That's it. If we're not in by 56.40, it's not going to happen. It's not for us, right? That's only for the first day. If the first day it doesn't fill, the order cancels. Once the order's filled, all we have is a target at 58, a target up at 60, and a stop loss. So we're in somewhere in here. Our stop loss is probably like right here. So stop loss, entry, target number 1, primary target. Right? The thing that we can't have is we can't have it gap through that entry box. It's not valid if it doesn't get to the entry box, but it's also, we can't get the reward to risk ratio we want if it happens to gap through the entry box. Does that make sense? So if it opened at 57, we can't get in. If it opens at 56.25 and then it gets to 57, well, we got in already at 56.25 and we've already ridden it to 57. So what it's doing is it's giving us a zone that says valid when it gets here, but not valid if it skips it. If it skips right through it, nothing happens. That's the trade that we're looking to set up, right? And we're looking to replicate what this trade would have done if we had done it here. And if we had done it here. Now, sometimes, or if we had done it here, right? And we're keeping some, we're moving our stops. My strike at 57, the strike is agnostic to any other consideration, Stephen. The strike price doesn't care about the stop, the entry, the targets. It's just a number, an out of the money number. If you remember, I said I'm looking for like a 0.3 to 0.4 delta. That's where I got it, was at the 57 strike. The 57 has absolutely zero bearing on where I think it's going or hope it's going. Irrelevant, agnostic, doesn't matter. It doesn't matter, right? All that matters is my levels, because I bought 35 days out. I expect to be in this trade no longer than March 14th at the very, very most. The very most. If everything goes right, March 14th. So I don't care about the expiration. I don't care about the strike price. I'm not looking to buy the stock at 57. I'm looking to get in, ride it, get my 2-1, get out. So the 57 is just simply the strike that was chosen. You could go run the numbers with the 58 and might be like, oh, I think I like the 58. It's a little more aggressive. It's going to do better if you reach your target, worse if it doesn't get there. Right? Someone else might go with the 55s. It's not going to do as well if it gets there, but it'll do better if the trade falls apart. So right? So it's not better, it's just different within its risk and its reward parameters and profile. Does that clear it up? That's a great question. Right? It's a great question. And one of the things you can actually do is you can go into the analysis and play with that. The delta, no. The delta is the target that I expect to hit is 58 and 60. The delta is also just kind of it's a byproduct. Right? It's a byproduct of the analysis. The core analysis is, where am I right? Where am I wrong? Where am I extra right? Where are my 2 right points and my wrong point? If I do a certain contract, how much do I lose? How do I control that risk? How much do I win? What's the ratio? That's what matters mostly. The delta, theta, vega, those are all byproducts of a option pricing model, which gives us an expected behavior. So all the delta tells me is, on the next dollar the stock moves, how much do I expect to get? So if the stock goes up $1, I only expect to get 40 cents. People are like, you only get 40 cents on the dollar. I'm only looking to pay $1. 40 cents on the dollar means I just made 40% on my option. That's not what I care about, right? Like the model is what helps us to quantify rewards and risks and not really thinking about like, oh, my the delta is just, if you buy calls, it's a positive delta. Delta is not a measure of quality. So it's not like 0.7 is better than 0.4. It's higher, but it's not better. In fact, I often find 0.4 is better than 0.7 because I could buy 2.4s cheaper than 1.7. And what do I have? I got 0.8 because they stack up. So my 2.4s that I got at a discount to your 1.7 is going to behave faster than yours at first and even more fasterer if the stock goes the right direction. And so that's why that pricing model is important for you as an options trader to be really pushing to get in. So trying to understand what will you actually pay? We don't know. We could try to extrapolate that. We're assuming that based on where it is now, if we're saying if the stock goes up to 56.05, that's about 50 cents, right? If the stock goes up 50 cents, the option will go up by about 20 cents. So I would say we expect to pay about $1.15. I'd say about $1.15. So because we don't know when it's going to break out, right? We don't know when it's going to break out, but when it breaks out, we're saying that's when it's valid. And when it's valid, we're saying, let's get in. Am I worried about the market makers giving me a bad price? No, because this thing has thousands of contracts of open interest. So yeah, we might actually think, if we're thinking we're going to pay $1.15, let's see if I can actually, I'm going to clear this out. We got to go. I'm way over time. This one got a little in the weeds, but I think it's going to be okay. I'm going to change. I think it's going to be $1.15 when we get in, if we get in. So this would be a 60-cent stop. So let's cancel and replace this to 60. And we're going to do the same thing on this one. Cancel and replace. We're going to make the stop 60 because we're not going to get in until the stock goes up. And if the stock goes up, the options are going to be a little higher, right? So, and then I need to add, we're going to make this, we'll just make this an even 225. That's about 2-to-1 on the first one. And we're going to make this one, we'll make this one 350, 325, 335, 335. Cancel and replace, 335. Okay, there we go. What do I have? I've got everything in place. If tomorrow it doesn't get past 55.75, nope. If tomorrow it doesn't get past 56.05, 56.05 is our threshold. So it's got to move up by about 50 cents. That's why we're thinking if it moves up by 50, we're going to pay about 20 cents more on the option because it's 40 cents on the dollar. So this is translating. Now, if I just did the stock, I could just do the stock. I could just be like, I'm going to buy 100 shares at 56.05. I'm going to put my stop at 54.75. That's a $1.40 of risk. I'm going to put a target $2.80 above, $5.60 above. And there's your trade. Easier, right? So if you're just a stock trader, this is easier. You can do all those same OCO, you could say, I'm going to sell 40 shares here, 60 shares here. You could have the same stop on both. Doesn't matter. There's no commissions, right? You're not paying commissions. So it doesn't matter if you have multiple orders managing at the same place. It's just keeping them separated. And then you could have multiple targets so that this thing is just managing itself. You come in, make some adjustments here and there. It allows you to have more trades on potentially, because things aren't going to get away from you. So I wanted to go up. Nope, you're close. You're still, Steven, you're close. Don't let that 57 stick you still, right? Above 56.05, but below 56.45. If it got all the way to 57, that's too far. That's only $1 away from the target at that point, right? So it can't get past 56.45. If it's above 56.45, this threshold is no longer met and the order will not fill. Does that make sense? 57, again, that's just the strike price. That's nothing. It really has no bearing unless you were going to exercise the option, which we're not. Since we're not, it just is like a placeholder of like, oh, that's our strike. Great. Right? Everything else is us built in. If I come in here to my analyze, let me just come in here. And I'm going to set these slices to the chart. Bam. Now look what I have. If I zoom in, a couple of clicks on here, boom, boom. Let's bring this down a little bit. You can kind of see, I'm not sure how it's putting these price like this here and this here. I don't know. Maybe maybe its model is telling me it's higher than I think it is, but I actually, I'd have to reevaluate once the trade was on. But you can see what it's doing here is it's got our stop. It's got our target prices up here. You can see how these are the OCO orders. It's got our stop price here, our first target, second target. Yeah, I'd have to look into this. I'm not sure if this is trying to extrapolate. I don't think I'm that far off, but I guess I'll have to see. All right, so that's building the trade start to finish. Now what? Now we just manage it. So we're going to look at this week and next week. If it doesn't fill, it doesn't fill, and it cancels tomorrow. If it fills tomorrow, we'll see it in the afternoon together. We'll see what it's doing, what orders are there. Maybe on Sunday, we'll spend a little time making sure we like where everything is and then manage that trade going forward. So if you're correct, the stock doesn't move past, well, the 55.75 is irrelevant as well. Because 55.75 to 56.05, there's no conditions between there. It's only a condition at 56.05. So basically, if it gets above 56.05, bam, trade fails. If it gaps above, so the anything between 56.06 and 56.45 is basically for a gap. If it opens below and then moves forward, when it hits 56.05, that's it. You're in. That range of 56.05 to 56.45 is literally for the opening price in case it gaps. If it gaps too far, we don't want it. Once it hasn't gapped, then you're waiting to see, does it get to your fill price at 56.05? If it does, it fills, then the rest of these orders execute. Bango, bango. That's the trade. Here's what I'm going to tell you. That might feel like a lot, and I might have opened the door for like a mini, like maybe we do like a quick break where we do 4 sessions of automated orders with conditionals and OCOs. Does that sound like it would be helpful? I don't want to put you in the weeds, but I want you working towards the type of stuff that's going to make you feel more confident that your orders are managed, right? That you don't have to sit and stare at it. And because if you're sitting and staring at it, you're going to make bad decisions, right? You're going to make mistakes. You do very simple buys and sells, right? Which are fine if you're constantly like you're doing it. But if you're really trying to optimize entries and exits and getting out at the time when you're supposed to, the more automation, the better. That's what we're looking for. Okay. Well, I'm gonna have to probably do like a a couple of recordings of these that will serve as resources for trade alerts, where we're like, hey, if you're going to do a stock, here's what it might look like. If you're going to do an option, here's what it might look like. I'm only going to do the stock and buying options. If anyone's trying to do spreads, you're on your own. You're doing spreads. You can figure it out. If you're buying options, I'll help you. Stock trades, this will be the automation. Otherwise, it just is like, hey, look, here's a stock. If it breaks out, do with it what you normally do when stocks break out. Perfect. All right, it's good to see everybody. I'm sorry I took an extra bit of time tonight, but this does kind of help me see a little more clearly what needs to be in place to kind of help promote this type of automation with the alerts. And I do think you'll find that being able to do that with the alerts is helpful. Thank you, Stephen. I appreciate that. It's good to see you again. It's good to see everybody. Tomorrow, I'll see you at 3:15 p.m. Eastern time. Have a great rest of your night. And as always, happy trading.